How's everybody doing? All right, today we have Chris Godfrey from CEPRES Corp. He's the president of CEPRES. With over 20 years of experience in private equity technology, Chris has held positions at Second Cap, Burgess, and SunGard Investgram, now FIS. He's also driven transformational technology at JP Morgan Chase, Hewlett Packard, American Honda Finance, and the Wellcome Trust. Chris holds a BS in physics and astrophysics. I think we would get along fairly well. From the University of Leeds, and is a frequent speaker at major industry events like PEI, Super Return, ILPA, in various cities around the globe. When I first learned of CEPRES earlier, I guess it was late last year, I think they have some very interesting data that we have all kind of come here to see, kind of peeking behind the curtain on private equity and getting a better understanding of what some of those fundamental drivers are. So without further ado, I'll hand it over to Chris.
Hey everyone. I was going to wear the jacket, but the humidity is definitely a topic for me. I just flew in from Denver, where you'll all be jealous. It's about 30% humidity right now. Let's see if this works. Hopefully everyone can see okay. As John introduced, and I'll give a little bit of background on CEPRES. Let's see if this works for I think it's working. Yeah, we just had a couple of versions. Yeah, so the animations are working. I'm going to get into a lot of data, and that's what we do. One of the things we do as a company, we're a data and analytics company, and I'll do a little bit of background so you understand the context of the data. As you know, there's data and there's data, and knowing what you're looking at and where it's coming from and the veracity of that data is one of the things that we focus a lot on. Especially in private markets, it can be quite confusing. A lot of people, out there who say they have all the data, they can tell you all about what's going on. The question is it valid and does it can you trust it in terms of what it's telling you? And it's one of the biggest challenges about private markets. It's relatively an intransparent asset class, but it's growing very fast. It's very large now, and we'll show you some numbers in a minute on that, and growing fast. And not only do you have a core institutional, I don't know how many of you are in the institutional space, pensions, insurers, family offices, endowments, etc., who have been long-term investors in private markets. You now have increasing attraction from high net worth, from private wealth, where you say, well, I also like to be involved in this asset class and get the benefits of what the asset class offers. One of the challenges is how do you then evaluate an asset class when you have limited information on it? So that's something we're going to go through today. So as background, I'm going to try and move over here. So, as it says, we all know, look at this week. It was interesting, I was finalizing this on Monday, and I'm like, hey, the whole universe just changed in a few days in terms of where the markets are at. Everyone was very bullish up until, I think, Warren Buffett called it first, sucked out all his money from Berkshire, and then the markets go down. Historically, a lot of people have thought private markets are not impacted by this, but they are. It's just that you have a discipline of you're in locked up funds that you cannot get out of. There's a very, very limited tight secondaries market for private markets, and it's not really significant. So the volatility and the uncertainty does have an impact. And whether you're an institutional investor or if you're a high net worth or you're an RIA or whatever trying to offer these strategies to your clients, you don't want them to get caught out. By the way, I should check. Can everyone hear me okay, or do I need to go back to the microphone? Okay, good. So you've got volatile inflation, uncertain interest rates, geopolitical upheaval, all these other contributing factors going into the mix here. And for private markets, as I said, the intransparency and the reporting lag. So if any of you are familiar with private markets, what happens is every quarter the funds will actually do a valuation takes them typically 2 to 3 months to issue all that data out to their clients and out to their investors. So you've usually got up to a 6 months reporting lag between an event happening and you actually getting any notification of that. And that obviously introduces a lot of uncertainty for people. So what we try and do at CEPRES is, first of all, help investors get more accurate information, more timely information, but also look at ways to take this forward without undermining the underlying concept of private markets, which is, as I have one lawyer tell me, private means private. So if we don't want it to become a traded market, if it becomes a traded market and a fully transparent market, guess what? All those returns are going to disappear. Because part of what makes private markets effective is the intransparency and the illiquidity of it over the long term. This is a summary of the data that at CEPRES that we have on the markets. So it's about 2,500 investment managers, 12,700 funds, 19 trillion of committed investor capital. So most of that is institutional. About 131,000 underlying deals. Last number, $50 trillion of enterprise value of companies that we have tracked in our database. So if you want to get an understanding of the scale, and that's over a history of time, but if you want to get an understanding of the scale of private markets today, that will tell you everything. We began actually after the dot-com crash in 2001 as a Center of Private Equity Research. The idea was, it was sponsored by, we're out of Europe originally, it was sponsored by European Union, 15 universities, do a risk and return study into private markets after the dot-com crash. I don't know how many of you in the room, like me, remember the dot-com crash, but some of us do. Markets go up and down all the time. And a lot of people lost their shirts, a lot of municipalities, a lot of institutions lost a lot of money in that. So there was this effort to look and understand what happened. What the group figured out is you have to have asset level data. At that point, nobody had asset level data in private markets. You had the fund managers, and the institutional investor would invest into the fund as a limited partner with no insight into what the fund was doing, and they would just wait for the checks to roll in. You know, distributions come, and they would take the money and they'd be happy. That happened, that's all good, until as we saw again in the GFC, and recently, the distributions dry up, and you're not making the same money that you were. So what we did at that point is we partnered with some fund of funds who are investing internationally to get their asset level data and started looking through to the underlying assets and to see the behavior of the assets they were actually investing in. Both the cash flows between the funds and the deals, how they were deploying money, how they were getting money back, income from those as well, but also looking at the underlying fundamentals of those companies they were investing in, where some of them didn't even have fundamentals, if you remember the dot-com era of people making up stuff they could do on the internet. So what we ended up doing was then being sponsored by that fund of fund, which became part of Deutsche Bank Private Equity, which was a $7 billion fund of fund. We spun out of there in 2010 and said we don't want AUM anymore, it was too restrictive to be held back by one group's AUM telling you how you could and could not work in the market. So we went independent, and we've been independent since, and we've been then working with institutional LPs and other participants in the market since then to help them get this data, analyze the markets, and understand better. The basis of what we do is, on behalf of an institutional LP typically, we engage with all of their institutional LP, being like a pension fund or an insurer or whatever, or a sovereign fund. We engage under mandate with their general partners, the private equity managers, and we get the data directly from their investment book of record. We're not going and doing FOIA requests, Freedom of Information Act. We're not scraping off websites of pension funds. We're not getting SEC filings that have limited data. We're going right to the source of the manager and getting them to send us their complete book of record, their fund accounting records, their portfolio management records, every quarter, all of the metrics of all of their companies that they're investing in. So it's the highest value privately sourced set of data out there. There's nothing else similar to this in the market. Just to give you an idea, we do a lot of breakdown of this data. We normalize everything we get. By the way, it's a mess what comes in the door. You can imagine every manager delivers in different formats, different ways, etc. The other thing to say is we're not just covering corporate, so we cover venture growth and buyout on the private equity side, as well as distressed turnaround, but we also cover private real estate, private credit, and private infrastructure. So it's all the big illiquids that we're covering. We don't do anything that's not illiquid at the moment. And then we break it all down into different segments for analysis purposes. We won't go into too much detail about this, but there's a lot of quality assurance goes on in between. As I say, we get a mess of different formats of data. We often get mistakes as well. And we're often going back to those managers and actually highlighting to them gaps or mistakes in their own data, which then they need to fix. So this is not just fire and forget and scrape data. We actually apply a lot of quality standards to it. We have about 680 odd automated quality checks. We check data quarter to quarter. We check valuations. We check operating metrics of the companies. If we see a spike in revenue or a massive drop, we'll go back to the manager and say, we see these issues with your data. Can you verify and confirm that they're accurate and correct? It's really important because our clients are investing off the back of this data. They're making investment decisions on multi-billion portfolios. So we need to make sure it's accurate. What we do have with the majority of the fund managers that we get data from, we sign all of them, we have an NDA with, so a legal agreement to how the data can be used, because this is private confidential data. And about 85–90% of them allow us to redact and aggregate that data into a market universe, which is what we're going to look at today. So this is the same data, but redacted and aggregated into slices that our clients also use for benchmarking, deal comps, and other purposes like that. So what we're going to do today is look at data over the last 20 years. We're focused on US private equity. We could cover any of the different asset classes, but thought we'll keep it tight. We do also cover all of European, Asia, and emerging markets as well. But on this session, we thought we'd keep it focused because otherwise we'd be here all day. And we're going to look at ways that you can measure private markets and then a little bit at the end about how you can apply this on your own portfolio decision making. My understanding is there's about 50-50 split of institutional people in the room and more on the advisory side, high net worth. I would mention this is mostly coming from the institutional space at the moment, but as a group we are working with a large group at the moment about how to bring private markets to the high net worth market, how to bring the level of analytics and data that's needed to make accessibility to those markets more, work better for high net worth investors. There's obviously a lot of groups out there, iCapital Case, others that are doing stuff around that. The gap still is how do you make sure that for your clients you're bringing them investments that you believe in and that you can put data behind. So that's an area that we're actually working on right now with a partner, and watch this space probably in about 3 to 6 months. There'll be some major announcements there in the market with that partner. Okay, first of all, what are we looking at here? And there's a series of these charts you're going to see, so hopefully you can read them all. We've got on the left-hand side, this is all, by the way, deal level data. I should say that first. We do fund level data. Everyone's seen the fund level data. You can get fund level data everywhere on private markets. Question is, can you believe it? We do fund level data as well, but for this purpose we're really focused on the asset level, what's going on under the covers, so that you can understand the root behaviors of the market. So on the left-hand legend, this is total value of the paid-in capital, money multiple, basically, of the deals. So not of the funds, but of the gross deal returns. On the right-hand side is EV to EBITDA, so basically price-to-earnings ratio. If you think about it in public market terms, it's the usual way that pricing is measured, multiple pricing in markets for private markets. So this line here is showing the pricing of all US private equity deals from 2005 to 2023. You can see there's a GFC dip. We'll come on to some commentary in a minute. Gradual increase, the spike up to 2022. So even as near as 2022, we were still seeing pricing go up. So post-COVID, the pricing of US private equity was still on the up. So only in 2023 we've seen this quite significant fall away there. So you can see the GFC, it was a very pure V-shaped bust and boom situation. So pricing dipped and then came straight back up. Within 2 years, 3 years, it was back up to the levels pre. I remember here, I worked for SunGard in this period where we'd been one of the biggest, the SunGard buyout was, I think, one of the biggest tech buyouts of its time, and everyone was like, how can pricing be so high on that? And look where we are today, the price inflation in assets. And then the steady increase over time, 2022. Now we've got the money multiple. So that's how much people are paying for deals. This is how much they're making on the deals, on gross deal returns. So you can see this dip away pre-GFC. By the way, this is always the way it works. Because they're illiquid, you're not trading on the day. You buy something here, you're not selling it. I remember at SunGard, I think it took 14 years to unwind the transaction in the end, and they sold to FIS. Yeah. So you buy something here. This is actually before the actual GFC impact. You've got this backward lag for private markets. But then you look at what happened after the GFC, this boost in returns, because basically there was lots more opportunity in the market. So managers were able to buy assets for better pricing, better deals, etc., and make more money. But from 2010, we're in a gradual decline of returns since 2010. All the way down to this period here. Now, what I would say is the furthest back you can probably judge returns in illiquid markets is maybe 3 to 4 years. You have to discount these last few years because mostly in private markets, there's no mark to market. They buy an asset, yeah, they have to do GIPS type valuations and have some kind of valuation basis. But you don't actually know what the returns are going to be until you sell the asset. It's like a house. You can hold it for 5, 10, 15 years. You can pretend you've got an increase in unrealized value, but until you sell it, you don't know what you're going to get. And that's how private markets effectively works because it's illiquid. So you can kind of discount these years to a certain extent, but you can definitely see, there's an increase up to 2019, but you can definitely see the overall trend in the market. So the trend is basically over this last period, increasing pricing, decreasing returns. So at some point you've got to say, okay, where does it make sense and where do I need to put my money in a market like that? Any questions about that? By the way, I'm open to interruption and questions as we go through. Please just shout out. Now we're going to look at it by different stages. So we've got venture capital, growth, and buyout, and see where the patterns shift when we look at those. So here we're just looking at the money multiples, again the deal level. So here's the VC pooled return. So if you're bought into the VC market, all the deals in the market in the US, your best year would have been 2012. You would have made a pooled 4.5x money multiple on those deals, which is a pretty awesome return. Even at this level, these are pretty good returns. But again, you can see the patterns going on here. And that was a boom after the GFC, all those great cheap deals that were in the market and picked up. Then you've got on the growth side, you can see it recovered a bit faster from the GFC. Here's the GFC period here, which saw the downturn. So any deals done in that actual period were not great comparatively, but very quickly after growth came back. But tends to be more volatile. You can see it more up and down. And then you've got buyout returns. So buyout returns are steadier play. Just remember, these are 2 to 2.5 multiples. So it's not bad returns. It's just choosing, seeing which market suits you better. So this shows that buyout has a steadier return basis. But again, you've got a certain amount of overall trend downwards, and again discounting anything from 2021 on because we don't know how they're going to pan out over time. and then that return, look at slightly negative returns coming in the last years in particular.
Chris?
Yeah.
What is the average holding period to achieve the multiple?
So that's an interesting one. We've done some analysis on that. Definitely, around the GFC, holding periods extended significantly after the GFC. It does vary. What we've seen, it's why we're doing money multiples, not IRRs. IRRs, you can kind of cheat the IRR, because if you flip a deal quickly, your IRRs can spike because it's very time sensitive, whereas money multiples are true money. It gives you that ultimate. So I know a lot of people manage private markets on an IRR basis. Venture, well, I'd say across all of them, in this kind of period here, holding periods reduced. I don't have the numbers in here. We have them, in our system. But holding periods definitely reduced over this period. Now holding periods are increasing again. Like we all know, venture distributions are down. They can't offload what they bought in the last 2 years. Show you a little bit more as we go through on some of the patterns in different sectors as well. Yeah.
Just so I understand TVPI a little better, is a 1 TVPI a
Flat.
Okay.
Yeah. Total value divided by paid-in capital. So it's literally the multiple of money you make on how much you put into the deal. I put $100 in, I get $150 out. It's a 1.5 TVPI.
Does that include debt pay down, distributions over the years?
It's total value of the deal. So it includes everything I put out and everything I got back. So yeah, if I paid for debt, if I paid fees, expenses, we track all that as well. That's all included in those. Deal fees and things like that will all be included in that calculation, yeah.
So 1 of 1, a TVPI of 1 is break even.
Is break even, yeah. Negative TVPI is a default on the deal. You lost money. Positive is you made money. Yeah. Please, yeah.
So make sure I understand the data set. So investment year could be any of these vintage years, but the deal was done in that specific year.
Really good question. Sorry I didn't emphasize that.
That's fine.
Yeah, no, it's a really good point. These are the year that I invested into the deal. So if I invested in deals in 2012 only, that's the return I made. Obviously, that's not the way it works in reality. Through a fund, you're investing across multiple, one vintage invests across 3 to 4 to 5 years. So there's a level of normalization there.
So the reason why I'm asking the question is I understand the statement or the view that you're making some of these more recent years here in the downward trajectory, but you could also say that the maturation of these companies just hasn't been looking up since those, so you don't have enough data to even know if the downward trend on some of the more recent years is truly showing the value that could be created in them. So how do you draw reference on today's period relative to history?
So that's why I said I would definitely discount to a certain extent this period, 3 years. Holding periods typically for private markets, growth and buyout tend to be shorter than venture, but they're usually 3 to 5 years historically. They are supposed to mark to some valuation basis. So the managers are supposed to do discounted cash flow models or do deal comps or market comps to give you a mark. So these you can see, and actually we looked at this, I'll show you in a bit, from 6 months ago, these numbers were different. The marks have changed that they're making. The topic is that they're speculative. They're not real until they're realized. This is a mix of realized and unrealized data. Obviously, anything going back to this point previous, these are fully realized deals. No one today is holding deals from back here still on their books. We do have the ability to break it down by realized and unrealized, just didn't do it for this analysis.
Sorry, one more thing. I'd be curious if you've ever done this, or we can take it offline, but if you actually took and looked at a static holding period, so only looked at the data if it's been invested and held for a minimum of 4 years.
Yeah.
So at that point of time, then it actually gets to the point of ramp in terms of value creation, post restructuring, whatever the strategy may be. then looked at that data? Because I think that would then show whether we're in a different regime today than we were back then.
No, it's valid. We have done analyses in the past. We have a lot of clients who, frankly, pay us to do different analyses for them. And one is, are GPs appropriately marking their deals before they sell? Are they marking down, marking up? Are they somehow playing the valuations? You know, so we've done analysis like that along holding periods and stuff. So we've got all the data. It's just what you can show in a lunchtime session. So if you're interested, absolutely give us a card. Or Robert here is with me. We can follow up and discuss. And anyone else the same topic if you've got more detail.
Yeah, my corollary is sort of what the gentleman was asking, but what is sort of a base rate fudge factor for, you know, so if we're sort of saying 21, 22, 23 is less reliable than 2012, for example, but, you know, is the base rate, like, when you look back on something 4 years ago, like, oh, it's not, right now this says 1.25 or whatever that eyeball is.
It'll
There's a
change.
decent chance it could be 6. Or,
No, it will change.
But
And
my point
as-
is, like,
yeah.
is there a way to sort of say statistically, like, the confidence interval?
Well, what I'll show you instead is in a bit we'll get to fundamentals. What do the company revenue numbers look like? What do their EBITDA numbers look like? That's how you can judge through. This is kind of, I would say, pseudo-technical analysis of the market. We'll come on to fundamental analysis. We also do quantitative analysis. I don't have any of that today. But yeah, you've got to choose. Yeah, please.
Your first chart at top quartile was an analysis.
Yeah.
Is this top quartile?
I'm sorry, yeah, if you can't read, this is pooled. So it's a good point. You know, most people like to think they're investing in the best deals in the market. So it's showing what you could get out. That first chart was showing what you could get out of the top of the market. This is showing the whole market. It's a good point. I'll try and call that out as we go. Apologies for not making that clear. Yeah, some of them have different metrics on them, statistical metrics, so just to illustrate different parts of the market.
Sort of a related question, I guess. In terms of the presentation of the data here, is this like an arithmetic average, or is this?
This is pooled. So this is saying if you invested literally in every VC deal that we have 30,000 VC deals in our market universe here. So if you invested in all of them, these are the returns you would have made by year. If you were able to invest in the whole market as a pool, that's the pool returns. To the gentleman earlier, the upper quartile is obviously the single deal at the upper quartile. And I'll try and call that out as we go, because it is important to get a different perspective. You know, you can obviously choose statistics, damn statistics. You can choose the ones that you want to show and illustrate something. And this is just an illustration of what's possible and what the market can tell you. Okay. Yeah, so crashes always create a good opportunity in the market. You guys know that. It's the same in private markets. People try and talk about private markets being different as an asset class. The difference is it's illiquid and intransparent. But it's still acting in the market that it's acting in. So you're buying deals at the market price, you're selling deals at the market price. It's just how best to manage that. And by the way, I'm not suggesting anyone should go out there and try and set up an angel fund and try and invest themselves. We're just trying to illustrate what the market cycles are like. Because the guys who do this, I mean, they're very good at it, let's be fair. But you have to choose the right guys to do it for you, the right managers. So this one now, this is where it gets interesting and does talk a bit to the valuation topics as well. So this is default rates measured by an economic default. So deal default being, I've lost money on the deal, it's been written down, it's under 1 on that TVPI. So literally we're counting the number of deals here that were written down by the managers in the periods of each year. So this one we're looking at VC. VC over time, if you look at it over 30, 40 years, we've got data going back 40 years, on average, it's a very bifurcated strategy, winners and losers. On average, 45 to 50% of deals lose money in VC, and 50 to 55% of deals make money. And then you get the home runs where they get 5x, 10x, 20x type of things and make all the money. So what we see here is actually in 2008 GFC, that's a normal rate. It kind of reverted to norm for VC in that period. It's normal to have a 45% default rate. What is abnormal is to have default rates down here at 10%. So this was an abnormal behavior market for VC in these years. That people are saying, I'm not going to mark down these deals. I'm making all winners. All my bets are winning bets in VC. That looks very like 1997, pre-dot-com crash. That everyone's like, you can't lose with VC. So it looked very similar. Look at what happened as soon as we hit actually not just COVID, but then interest rate rises and changes in the market, just straight back up. Because they weren't, it's the same thing as the dot-com crash. There was a lot of bets there was a lot of secondary transactions going between managers. Oh, I'll invest in this, I'll sell it to you, make money, I'll sell it to you, make money, etc., etc. There's a lot of, not such perfect deals being done, but, the chickens come home to roost, and we're back to normal default rates for VC.
Quick question about 2023. Do you have any data like breaking out how the failure of Silicon Valley Bank impacted VC?
No, and that may be related to the spike. It's a good point. Haven't really thought about that. But yes, it definitely had to have had a massive impact. Interesting aside, they wanted to buy us at one point, and we're very happy we stepped away from that. So this one is growth. So you can see here that it comes in, it also peaks during the GFC, settles down, but it's, as we saw earlier, more volatile. But likewise, we've got this pickup. Oh, by the way, let me highlight, sorry for this as well. This is as of Q4 2023 data. So this is data we had at the end of the year in 2023. And I'm going to show you fresh data in a minute, and you'll see a difference here. And it will talk to some of those points that were raised earlier. And then we have buyout. Really interesting thing is all strategies had a similar default rate in the GFC, which is like, seeing that is extremely unusual. So buyouts really that's a very high default rate for buyouts there. And all have now seen a spike up post 2020 there. So you see that convergence happening. And then you see a reversion to norm, really, this gap between VC. Growth is usually high, usually, if you have private credit, it's down here, by the way. Private credit is a much safer strategy as an illiquid, but it doesn't have the same level of return, so you're offsetting risk and return there. So you see this general overall reduction in defaults, unnaturally so. So I think this was building in the market, this stress on the market. And then this post-COVID or post-SVB peak or post-interest rate spike peak, etc. happening there. What I'm going to show you now, that's what we just looked at for the last few years, and this will talk exactly to the points you raised earlier. This is the data for the same period, updated with Q2 2024 data. So what you see is, at the end of last year, managers were seeing stress in their deals at this level, but since then, the level of defaults has come down for the same period of deals. So they've looked at their deals and they've said, yes, we were under stress at that point, but we've recovered some of that stress. We're seeing them as being not as negative as they were when we looked at it at the end of last year. They're now looking more positive. So there's a positive trend in the market. We'll see in the next months what happens out of this volatile period again. Because remember, all of these are investing in the US, equity markets effectively through private transactions instead of traded transactions. But they're in the same market. A company goes public or a company stays private, it's still acting in the same overall market. So that shows how over time these things will shift. Yeah, please.
Just a clarifying question, sorry, I keep asking
Yeah,
this.
good.
I'll have better insights into how you drew the data, but in terms of the default rate for ventures, an example, is this, you mentioned something earlier about below 1 on a TVPI basis, but are these full write-offs to zero
No.
financials?
Just means they're being written down, not full write. We track write-offs as well. I don't have it on here.
Just curious.
But yeah, it means they've been written down to below par. So someone said, okay, I'm now at 80% of 80 cents on the dollar or whatever.
And this is purely just based on count, not dollar weighted or anything like that?
Yeah, this is purely count. We do a loss rate, which is a capital weighted calculation as well.
I'd be curious to see that data from venture, because most of the time they're proactive.
You definitely need to talk to us afterwards then. Yeah, please.
Maybe I'm slightly skeptical, but I also think your comments earlier about like you guys are cleaning a lot of data. There's a lot of incentives in this, right? Like, no, this thing's good, I promise. You know, like you're getting data from these companies that have marked it themselves. And yes,
Oh yeah, this is their mark.
valuations.
Yeah.
Right, like I'm not saying that, but like when you're looking at I imagine in my mind, like, you know, regularly you're getting all this data and like sometimes it's transposition errors, but sometimes it's other stuff. And I'm just curious, like when you're looking through the data, are there any like triggers that are basically like, this is a totally untrue mark? You know what I mean? Like
That's where we do look.
Like I promise this is asbestos company.
I mean, we're not doing an audit. So we're not an audit firm, we're not auditing
No, I understand.
the basis of their calculation. We take, but as I say, like where we see, you know, this is a pooled group of thousands of deals.
Sure,
So
yeah,
this is
no.
over a market, you know, this isn't one or two deals. Where if we saw this happen between 2 quarters on a single deal, we would definitely go back and say, can you confirm, we see there's a big shift in an upshift or a downshift in a metric, in a number, in a revenue number, can you confirm that that's correct? Because and we'll give them a list of flagged errors, it's all automated.
That's what I was thinking
Yeah.
about the 180 things, and like, is one of these frankly a bullshit detector to be like, this is total crap?
I can get you the list, I don't do it, we have a whole
No,
team
I know,
that
I'm
do
just
this.
curious,
But,
though,
yeah,
like, there has to be some that.
It's 680 by the way.
It's 600, okay.
Yeah. Because by the way, we're tracking about 150 metrics for every deal on this. It's a lot of data that we're doing. And you can't do that manually. So we get their records, and
You talked about flags, that's what I was
we
saying.
look for the
Yeah,
flags.
there's some flags.
Something's changed. Something doesn't match up. You've got a revenue number for a company where you haven't got any investment number going into it. We'll flag that. There's records missing, there's data missing, et cetera, et cetera. But yeah, we are relying on the manager's book of record to be accurate. But that's why they get audited. We take the audited financials and things like that from them. So we have to rely on their records. But I think this shows that it does shift. These are investment years, as you highlighted before. So it's saying that, in 2022, especially the growth deals, which have a default rate over 40%, now have a default rate just over 20%. So there's more confidence in those markets. There might be some new deals in there, but the majority, since it's so new, it's going to be the same set of deals that are in there that are showing that over time these things will change. Yes, please.
You're using the word default rate,
Yeah.
but I think to just clarify, it means it just goes below par.
Yes.
And also, if it goes from 1x to 2x, and then goes to 1.5x, does that show on your data as a default rate?
No. A default means it's below
Has to go
par.
below par.
It's been marked down from its
If it's
original
0.9,
price. Yeah.
It's not a default.
I'm sorry?
It's not a default, I mean,
It's a term, so private markets tends to use different terms than public markets. So it's not like a covenant default or something like that. It's just saying it's been marked down to below par. So yeah, it's
Would you guys use one
specific.
underwater or something? Like,
Yeah. The deal is underwater.
It's just underwater, right?
Yeah. This one just to show how money is being deployed. So this is showing the percent. I'm sorry about the colors. Percentage of money, technology deals. This is the enterprise proportion of enterprise value invested by private equity investors into each part of the market. Technology deals, consumer deals, financial deals, healthcare deals, industrial deals. So it's showing over time since 2005, and this is again investment year, how money is being deployed. So you've got this GFC. This is proportional, so there's a lot less deals done. But you can see that there was, proportionally more consumer happening during the GFC year, even though it would be much less money deployed. and then this big spike post-GFC into tech. So tech became very dominant. It's been a little bit on and off, but overall it's become 40% of the market in private markets since the GFC. You've got this interesting expansion around COVID of consumer. And this is a massive expansion into the consumer space. All governments all around the world, the US is everywhere, throwing money at people to sit at home and have leisure time. And that got deployed into consumer businesses in that period of time. You also see an expansion in healthcare after COVID. Everyone chased down, thought, oh, this is the latest, greatest thing. You'll see the results of that in a minute. So you have these the private markets are just as changeable as other markets in where people want to invest in terms of the managers and they're chasing after. And you've got to think about that in discipline, the managers that you're giving your money to, that are they disciplined? And just recently, we just saw this in 2023, big expansion in financial services. So it's actually financial services in 2023 was slightly bigger than tech in terms of private markets, money invested. So here we're going to look at by sector. So consumer, you can see here, and see the spike there. That's when all the money flow into it. Guess what? You put more money into a market, pricing goes up, returns go down. Same as any market. So everyone, or loads of managers chased into the consumer sector. Then you've got healthcare, same thing the year afterwards. After the year after COVID, all the managers were flowing money into healthcare, thinking this is the next thing since sliced bread to come back. And then you've got tech still dominant, and look at how dominant it has been. But 2023, pretty much all the pricing has come down. Between 2022 peaks, or here on consumer, the peak was 2020, falling away, 2022, peak of tech, peak of financial services, and then 2023, all pricing has basically come down and corrected. Now looking at the default rates by industry, it's actually a bit more of a muted picture. And by the way, we chose just here consumer, healthcare, financials. Default rate being the deal is underwater, so it's lost money basically. So you can see the normal levels in consumer. Actually, interestingly enough, when we looked at this 6 months ago, consumer in 2020 had a much higher default rate, but it's softened. So again, confidence has come back into that market and into the deals. So the data, we don't have the Q4 data, but it was much higher default rate there. Then we see on the healthcare, it definitely still is those deals that were done post-COVID were definitely too rich and paying the price of that. And then you've got tech, and you don't expect, again, if you see high defaults within a year, that's a really bad sign. So it's quite normal to see this drop off again because of the timing topic. You don't expect a deal to be marked down in the year or the year after someone's done the deal unless it's really in a bad situation. And you see this kind of very flat and then the spike for the last couple of years. I think there's talk of somewhere, I don't know if it's 7 years or something, cycles of the market, that type of thing. A bit more extended here. We've had a very benign market for the last 10 years. But definitely there was a build-up of stress, I think, in the market to reach those points there. What's that? Financial deals obviously massively hit with the GFC. That makes a lot of sense because it was very much a financially driven market event. And too early to tell at this point. Okay. This is looking at we're now moving into the fundamentals. I hope I'm doing okay for time. Let me know if I need to speed up at all. This is looking at, we get every quarter the revenue, EBITDA numbers, margin numbers of the businesses that are actually investing in. So this is saying by investment year, how in 2005, what was the compound growth rate of those deals done, of the companies invested in by a private equity company over the life of that holding. So if they held it for 4 or 5 years, what was the compound revenue growth they achieved out of it? The really interesting thing is when you look at the pattern, and we were talking earlier a little bit about revenue numbers, you can see a general nice increase and then this spike, that whatever was going on in the market in these few years here, the 2020 deals, and this is based on latest numbers, just have outstanding revenue growth in those deals. So those companies that are being invested, and probably a lot of that is tech, as we saw, there was a lot of tech deals, but the revenue growth numbers are being outstanding, and now they've fallen back to more normal levels, so, 6, 7, 8% compound growth rates. And again, this is based on a large pool of data. In this case, it is a median number, so it's looking at the middle of the market based on the companies invested.
Hey, Chris,
Yeah.
it's 1 o'clock. I know we ate into a lot of your time with the annual meeting stuff.
No problem, yeah.
So feel free to keep going, but just...
Anyone can stay or leave as they want to based on the whether it's interesting or not. Oops, is that stuck? There we go. So now looking at sector specific, so we're into healthcare, we looked at this before a little bit, but combining it together. So this is the price paid for healthcare deals, and you see that spike in 2021. And then, sorry, for some reason this is struggling. There we go. We've now got how much money has been made, so again, the money multiple. You've got the same thing of saying whether or not these last few years are really valid because of the timing, and these include unrealized deals. But you can definitely see the overall trend. Increased pricing, decreased returns over a long period of time. Sorry, I seem to have a bit of a lag on the computer here. Let me go back one. Sorry about this. There we go. So this overall trends, pricing increasing, returns decrease. Anything up from here backwards, this is most likely realized deals. So you can see that overall trend in the market. So my guess is these deals done here are not going to make great returns because they're very highly priced in the market, and getting that multiple forward is going to be very difficult. Okay, this one, sorry, the animation's messing up a bit. What this is doing, and let me clean it up. Oops, come on. So we're looking here, focus on one chart for a minute. This is what's called a value bridge. So it's trying to determine how the value of the company has been increased or decreased based on the fundamentals. So this is the pool enterprise value, and these are in millions, so this is $300 billion worth of enterprise value of companies backed by private equity, 350, say. So between 2015 and 19, that was the starting place of what was invested in the enterprise value of the healthcare companies. This is how much of the revenue growth of those companies contributed to the valuation of the company. So it's a decomposition of the valuation based on drivers, revenue, margin, and multiple. And multiple is the pricing multiple, so how much the market price was. So you can see 2015 to 19 for healthcare, very solid. Good growth in enterprise value of those companies from 350 up to almost 700 billion. Most of it driven by revenue and pricing multiple. So the expansion of the increasing, remember that's the way the line went, with pricing increasing. We now shift to 2020 to 2024. There's relatively similar, sorry about the scale here, but it's self-determined the scale. So it's a relatively similar amount of value investing, a bit more actually into healthcare. And remember that spike we saw in 2021, probably due to that. Revenue is still a factor and leading to growth, but there's a negative margin expansion. So those businesses invested were actually doing worse, shrinking their margins that we're investing into, and a very weak multiple expansion. So that was the time where we've seen the dip off in the pricing. So overall, a real shift in the way that value is being created in these companies. So remember, you asked about, well, what about the TVPI, if it's still held and stuff. These are the fundamentals of the companies. So the company fundamentals have shifted between the last, that 15 to 19 period and the 20 to 24 period. And we got a similar one now, just looking at technology and other key sectors. So you see there again this spike up to 2022 in this case, the falling away of pricing multiples in tech. The one here I wanted to highlight, because this is an interesting pattern. The GFC period here, what you saw is a massive expansion between the losing deals. This is the lower quartile of returns, so negative returns for a lot of it, and then just flat, versus upper quartile of returns. And you see this bifurcation of the market into winners and losers post-GFC. So a quarter of the market is making no money at all in tech, and a quarter of the market is making all the money. So it's a really interesting thing there. But again, you see this overall depression, increase in price, reduction in returns, nice spike up here in 18 to 19 in returns, so they were good years, but after that, definitely a negative trend, and then we have to wait and see what happens for the most recent vintages. Again, on tech, looking at the fundamentals. So here, note the numbers here, almost, what's that, I guess $1.5 trillion almost of invested money in a 5-year period, or not invested, of enterprise value of businesses invested into. Big revenue growth, moderate margin, decent multiple. And look over here, what we have on the other side. The revenue is still there, some margin is still there, but the multiple completely opposite direction. So all of those deals, it's almost flat in terms of value creation beginning to end in the last 4 years. But all those tech deals, we have to wait and see what happens on the multiples. If the multiples do pick up again, obviously there's a lot of inherent value there. But if they remain flat or stay or come down, then obviously that's going to be a big impact on the returns for those deals. That's a lot of the basis of the data presentation. Any questions about the remaining that I show there, the fundamental data, revenue, anything else like that? Happy to answer. Yeah, please.
On the two bridges, I'm sorry, which part was saying it was down? How do we determine whether something was down or back to the technology one, you can kind of eyeball it, but healthcare, it looked like some of them were positive.
I know, I apologize. Sorry, I'm struggling here with this thing.
So you're saying
in our software, this is coming straight out of our software.
Yeah, right.
It's a screenshot out of the software. It actually tells you, and you can hover and it says this is positive, this is negative.
on the left, those all look positive. On the right, you were saying that
You can
revenue growth was positive,
Yeah.
but multiple expansion was down, like negative, like.
What you can see is it's literally adding up. So from here, the top of this,
Okay,
that adds, that's negative.
got it.
You have to, just because it's on a screenshot, sorry about that.
But that's the first one where there's been a negative factor. Right?
Yeah, look at
For
that
healthcare,
massive,
they're all added to it.
just on the pricing of the deals. Because remember that chart, we are pricing up at like 25 plus multiples. That's unprecedented. So just the fall away in that pricing is what we're seeing there. And this is all based on latest data from the managers. So, this is the real market today of the latest data that we have.
I'll ask one question since you already went back here. One of the other components usually is debt reduction.
Yeah.
So that's either embedded somewhere within the assumption or it's just not shown.
This is enterprise value.
Sure.
So debt doesn't impact on the enterprise value.
Yeah.
We have separate, not in here, but we track the leverage and leverage expansion and contraction. So we,
in general, there's 2 periods of time, maybe just, if you were to add that in and look at the relative pieces of value creation or destruction,
yeah.
What have been your insights into these?
So maybe I should have had a leverage one in here. What we've generally seen, pre-GFC, massive amounts of leverage in buyout. Post-GFC, generally leverage has been more managed. It obviously goes up and down a little bit, but more equity going in. So I think there's more capacity to deal with the markets because there's more equity in play and less leverage. But we know that obviously with interest rates, anything with serious leverage in it is under stress at the moment. Hopefully that will tail off as we go forward. That's creating an opportunity for private credit, by the way, obviously, because private credit is more, is willing to take on more risks than the banks. So we've seen an expansion in junior credit in the markets, and as the seniors pull away. Not as much as a difference as you saw in around the GFC period. The best year for private credit was 2009, because all the banks retrenched, and anyone with any credit funds out there just stepped in and did fantastic deals. They made so much money out of it; it was unbelievable. So. Okay, and then one thing to hear, and I can actually see if, I don't have an internet connection. I was going to bring it up live. So all that data is by the way, that's a fraction of the data that we deal with. It's just to give you a flavor and some indicators of the market. We also, one of the topics is we're still limited by the lag and the reporting of the managers, as was talked about. So we still have to get the data from them. What we've done, this is one partnership we've done with Solactive, who are an index provider. And we've worked with them to use our private markets asset level data for them to create a tracker index. And you can go and look it up. If you look up Solactive CEPRES index, I think it's maybe on here, if I can get it to open up. Oops, no. I thought I had it on there, the link, but, there we go. But you can search for CEPRES Solactive, you'll find this. So it's a tracker index. What you can see, I don't know if you can make it out. I was going to do it live, but again, I don't have the internet connection. So this is literally the last few days. So what we're doing here is we're using, basically a factor model to look at how public markets correlate to private markets, or the other way around. And this is what's happened in the last few days. So, having something that allows you to understand what the impact on private markets assets are of the public market behaviors helps you. It's not saying you can do much about it, like there's no secondary market, but at least you can plan and look at where you want to deploy, what strategies you want to be in, what managers and how those managers behave. That's something that we do. But this is also obviously could allow you to hedge, could allow you to look at alternative strategies. We've done a similar thing with Axioma, if any of you are familiar with their risk management system. They use our private markets data to do risk factor models for private markets for their clients. So taking this data and deploying it in a way that makes it more real time is where we're going as a company at the moment, trying to bring this into focus. Sorry, I'm having struggles here with this. And I wanted to just quickly talk about how this can be used and deployed. So everything you see today comes out of our data and analytics platform. Use cases, this is the most common, institutional portfolio monitoring. So again, one of the problems with private markets is getting access to the data. So we help these institutions to get this data and be able to analyze and do all this performance attribution and analysis and leverage analysis and value creation. They do it all on their own portfolios. And that's where all this data is ultimately coming from. The other use case, and this is kind of based on a quarterly cycle. Sorry, there's a really weird thing going on here. Oops, did it again. The other major use case is due diligence or underwriting. So if you're investing into an illiquid fund, what's most important, you get it right up front, because there's a very, very limited secondaries market, and everyone loses on the secondaries market apart from secondary fund managers. So the only people who make any money on the secondaries market. So understanding and doing a deep analysis of the track record of a manager, how did they behave? How did they deploy leverage? How did they create value in their companies before you give them the 1 million, 10 million, 100 million, 500 million check? That's really important to get right. So that's another use case that we have. And the last one, which is sorry, just keeps doing it. Really key topic is how do you know what's going to happen in your portfolio? So again, in traded markets, you can buy and sell out the market. So if you have a liquidity challenge, you can go and sell what you want to sell, achieve some liquidity. You can't do that in private markets. So you don't know when money's going to be called. You don't know when distributions are going to come. So we do this quantitative modeling around how the money is actually going to flow over a long period of time, 5, 10, 15, 20 plus years, and how you need to deploy into the market and have future commitments into the market to maintain a NAV, a net asset value of the portfolio, or to achieve certain returns. So basically we take all this data and we feed it into models and things that help people to predict what's going to happen and how I need to be engaged in the market. That's basically it. Sorry for overrunning, and great questions, by the way. I'm open to any other questions. Please, yeah.
I'm just curious, when you're talking to some of these investors, like, you got to be, or some of them, like, not very sophisticated, or just the education process to be like, this is the kind of stuff you need to be asking. Like, there's some people, like, a lot of, like, oh, we never would have even asked for this data, right? And
it's changing. I'll tell you, the most sophisticated private markets investors are in Canada. They are pushing the envelope all the time, and we have a lot of Canadian clients because they like this level of data. Then America comes second, sorry to say, but once your neighbors in the loft are ahead of the game here, and a lot of those guys are investing in direct assets as well themselves. They have big books, in real estate and infrastructure, especially, but also in corporates. They even invest in the private equity companies themselves. Some of the big groups have been bought out by like Canada pension plans, stuff like that. The American market, you've got a very sophisticated fund-to-fund market here, who are still, there was a time when fund-to-funds were off not very popular. They've become much more popular again because they can deploy into, different niches, different parts of the market. But also, a lot of the family offices here are really sophisticated, big family offices. Also, the insurers have always been super sophisticated in the numbers, in the weeds and stuff. And that's spreading now to more of the state pensions, the retirement systems, things like that. And the endowments are now picking up. They used to be all OCIO. Now they're starting, like the Yale and Princeton's and groups like that are starting to get more in the weeds of things and take more self-empowerment. I think that's a topic as well. Europe comes next, and then Asia quite a way behind. So that's kind of the sophistication bias, but everyone is following on. And when you get a market correction or problem, people start saying, I can't just throw money at the wall anymore and see more come back. When that happens, nobody's interested in the numbers. As soon as it goes wrong, everyone's like, what went wrong?
Yeah.
So this is our busiest we've ever been as a company, where everyone's like, I need data. I can't make any decisions without the data. So having that data is really key now. Okay, thank you very much, everyone. Appreciate it.